Hello, welcome to Capital Sensei. Today, we're going to dive deep into a powerful yet elegantly simple investment philosophy laid out in a book called The Dhandho Investor by Mohnish Pabrai. We'll explore the core idea of heads I win, tails I don't lose much, break down the 9 principles of the Dhandho framework, and understand how to spot investments that offer low risk but high potential returns by looking for something called high uncertainty. It's a way of thinking that can fundamentally change how you view both the stock market and business itself. Whenever we can, we try to answer questions that pop up in the comments section. The best way for us all to learn is by sharing our experiences and our questions. So, if anything we discuss today sparks a thought, or if you have a story about an investment you've made, please share it below. Creating a community where we can all learn from each other is the goal here. So, who is this Mohnish Pabrai guy, and what does Dhandho even mean? Pabrai is a highly successful investor who openly admits he's a cloner. He didn't invent a new system from scratch. Instead, he studied the greats, particularly Warren Buffett and Charlie Munger, and distilled their wisdom into a focused, actionable framework. Dhandho is a Gujarati word, and it roughly translates to endeavors that create wealth. But it's more than just business. It's a specific approach to business, one that focuses on maximizing rewards while obsessively, relentlessly minimizing risk. The entire philosophy is built on a beautiful, real-world story that Pabrai uses to illustrate the concept perfectly. It's the story of the Patel Motel phenomenon. In the early 1970s, a wave of Indian immigrants, many with the last name Patel, were expelled from Uganda by the dictator Idi Amin. They arrived in places like the United States and the United Kingdom with very little money, often just a few $100s to their name. They needed to find a way to make a living, and fast. A surprising number of them got into the motel business. Now you might think, how can someone with almost no capital buy a motel? Well, this is where the Dhandho genius comes into play. They didn't go after the shiny, new Holiday Inns. Instead, they looked for small, independent, often struggling motels that were for sale, the kind of place the average investor would run away from. Here's how they structured the deal. Let's say a motel was for sale for $500,000. A Patel family might have only $50,000 in savings. They would go to the owner and offer that $50,000 as a down payment. Then, and this is the key, they would ask the seller to finance a large chunk of the remaining $450,000. The bank would finance the rest. The seller was often motivated to do this because the motel was distressed and hard to sell otherwise. So, the Patel family puts down very little of their own money. Their downside is capped at that $50,000. What about the upside? Well, they didn't hire a bunch of staff. The entire family moved into one of the motel rooms, effectively eliminating their own housing costs. The husband might manage the front desk, the wife would handle the cleaning, and the kids would help out after school. They ran the entire operation with sweat equity, keeping costs at rock bottom. Think about the risk-reward profile here. If the business fails, the family loses their $50,000 and the time they put in. It's a painful loss, but not a catastrophic one. The bank and the original seller who financed the deal take the biggest financial hit. But if the business succeeds, by keeping costs incredibly low and running the place efficiently, they could pay down the debt and build up equity. Within a few years, they could own a valuable asset, a cash-generating machine outright. They turned $50,000 into an asset worth many times more. This is the essence of Dhandho. Heads, I win big. Tails, I don't lose much. I don't lose much. This real-life example forms the foundation for Pabrai's 9 core principles. It's a framework designed to find these Patel Motel type investment opportunities in the stock market. The first principle is to focus on buying existing businesses. The Patels didn't try to build a new motel from the ground up. That's incredibly risky. You have to deal with construction, permits, and building a customer base from zero. Instead, they bought an existing business with a track record, existing cash flow, and a known set of problems. In investing, this means buying stocks of established companies, not betting on speculative startups. It's just easier to figure out what a company with 10 years of financial history is worth than a company with a great idea but no revenue. The second principle flows from this: buy simple businesses. The Patels bought motels. It's a straightforward business model. You rent out rooms, you clean them, you collect money. You don't need a PhD in rocket science to understand it. Pabrai argues we should do the same with our stocks. Invest in companies whose business models you can explain to a 10-year-old. Think about candy companies, soft drink makers, or trash collection services. He specifically advises investing in industries with an ultra-slow rate of change. You want a business that will likely be doing the same thing and be just as profitable in 20 years as it is today. High tech is exciting, but it's also a minefield where today's giant can be tomorrow's fossil. This leads us to the third and perhaps most contrarian principle: buy distressed businesses in distressed industries. This sounds scary, right? It's the running into a burning building school of thought, but it's where the best bargains are found. When an entire industry is out of favor, think about the shipping industry during a global recession, or the oil and gas sector when prices crash. Investors panic. They sell everything, the good and the bad, indiscriminately. This is when a Dhandho investor gets interested. The Patels bought motels nobody else wanted. Similarly, Pabrai looks for solid companies that have been unfairly punished because they're in a neighborhood that's temporarily on fire. The goal is to find the one house on the block that's built of brick, while all the others are made of straw. Of course, you can't just buy any cheap company. That's a classic value trap. This brings us to the fourth principle, a concept borrowed directly from Warren Buffett: buy businesses with a durable economic moat. A moat is a competitive advantage that protects a company from competitors, just like a moat around a castle protects it from invaders. Moats come in several forms. It could be a powerful brand name like Coca-Cola. It could be a network effect, where the service becomes more valuable as more people use it, like Visa or MasterCard. It could be a low-cost advantage, like Geico in insurance, or a high switching cost where it's a huge pain for customers to leave. Like trying to switch your entire office from Microsoft Windows to another operating system. A Dhandho investor looks for a distressed company that, despite its current problems, still has its moat intact. Now, once you find one of these incredible opportunities, a simple, distressed business with a durable moat that's trading for way less than it's worth, what do? This is where principle number 5 comes in. Bet heavily when the odds are overwhelmingly in your favor. Traditional financial advice preaches diversification. Own a little bit of everything. Pabrai and many other great value investors argue against this. When you find a true heads I win, tails I don't lose much situation, you shouldn't just take a small position. You should make a concentrated bet. This doesn't mean being reckless. It means that after doing immense homework and confirming the high probability of success and low risk of loss, you invest with conviction. You may only find a few of these opportunities in a decade, so when one comes along, you have to act decisively. Principle number 6 is to focus on arbitrage. Now, the classic definition of arbitrage is risk-free profit, like buying a product for $10 in one place and simultaneously selling it for $11 somewhere else. In the real world of investing, pure arbitrage is rare and fleeting. Pabrai uses a broader definition. He's looking for situations where there's a disconnect between price and value that is almost certain to close over a short period. He gives examples of merger arbitrage, where you buy the stock of a company being acquired for slightly less than the acquisition price, capturing the small spread once the deal closes. The core idea is to find specific, event-driven situations where the outcome is highly probable, creating a low-risk return. This all hinges on the seventh and most fundamental principle of value investing: buy businesses with a deep margin of safety. This concept comes from Benjamin Graham, Buffett's mentor. The margin of safety is the difference between a company's intrinsic value, what it's truly worth, and the price you pay for its stock. Let's say you do your analysis and determine that a company is worth $100 per share. A margin of safety means you don't buy it at $95. You wait until you can buy it for $50 or $60. That huge discount is your protection. It's what makes the tails I don't lose much part of the equation work. If you are wrong about the company's value, or if things go a bit sour, that deep discount provides a cushion that absorbs the negative impact and prevents you from losing money. This next principle is subtle but incredibly important. It's principle number 8. Invest in low-risk, high-uncertainty businesses. This sounds like a contradiction, so let's break it down. The market often confuses risk with uncertainty. Risk is the probability of a permanent loss of capital. If you invest $100 and there's a 50% chance it goes to zero, that is high risk. Uncertainty, on the other hand, is when the range of future outcomes is wide and difficult to predict. The market hates uncertainty. When a company's future looks cloudy, investors get scared and sell, pushing the stock price down. A Dhandho investor looks for situations where the uncertainty is high, but the actual risk of permanent loss is low. Imagine a great company, a leader in its industry, that gets hit with a major product recall. The headlines are terrible. Analysts don't know how much it will cost or how much it will damage the brand. The future is highly uncertain. The stock price tanks. A Dhandho investor would dig in and ask, is this problem temporary? Can the company survive it? Is its long-term earning power still intact? If the answers are yes, then this is a classic low-risk, high-uncertainty situation. The low price, driven by fear, provides a huge margin of safety, low risk, while the resolution of the uncertainty provides the massive upside potential. The final principle, number 9, is one that Mohnish Pabrai lives by and talks about with great pride. It's better to be a cloner than an innovator. He argues that in both business and investing, trying to invent something completely new is incredibly difficult and has a high failure rate. It's far more effective to identify what already works and copy it. Sam Walton didn't invent the retail store. He perfected it by cloning and improving upon the best ideas he saw. Pabrai didn't invent value investing. He took the proven frameworks of Graham, Buffett, and Munger and applied them rigorously. There is no shame in this. The goal of Dhandho is to make money with low risk, not to win an award for originality. Find the best investors, understand their models, and shamelessly clone their thinking processes. So, when you put all 9 of these principles together, you get the Dhandho framework. It's a mental checklist for finding those rare, asymmetric bets. You're hunting for a simple, existing business in an out-of-favor industry. You need to make sure it's protected by a durable moat. Then you wait patiently, and this part is crucial, for a moment of high uncertainty to create a crisis price. That low price must give you a massive margin of safety relative to the company's intrinsic value. When you find this perfect alignment of factors, you bet heavily, and all along you're guided by the wisdom of others, shamelessly cloning what has been proven to work. How does a regular person, someone who isn't a full-time fund manager, actually use this? The first step is education. You have to put in the time to learn. Read Pabrai's book, then read The Intelligent Investor by Benjamin Graham. Read Warren Buffett's annual letters to Berkshire Hathaway shareholders, which are available for free online and are a masterclass in business and investing logic. You need to build the foundational knowledge first. Next, you have to learn the basics of business valuation. You don't need to be a Wall Street analyst with a complex spreadsheet. You just need to be able to make a reasonable estimate of what a simple business is worth. You can do this by looking at its past earnings, its assets, and comparing it to similar businesses. The goal isn't to be precisely right, but to be approximately right. You want to know if a company is worth roughly $100 per share when it's trading at 50. The exact value might be 90 or 110, but that doesn't matter if your margin of safety is huge. Perhaps the hardest part is cultivating extreme patience. Dhandho opportunities are, by their very nature, rare. They only appear during times of market turmoil or when a specific great company hits a temporary and solvable roadblock. This means you might go for a year or even longer without making a single new investment. You have to be comfortable holding cash and waiting for the perfect pitch. As the saying goes, in investing, the batter stands at the plate and gets to see thousands of pitches. There are no called strikes. You can wait all day for that one perfect, slow, fat pitch right down the middle, and only then do you swing. This mindset requires a fundamental shift. You must stop thinking like a stock trader who watches daily price wiggles and start thinking like a business owner. When you buy a stock, you are buying a fractional ownership piece of a real company. You should ask yourself, would I be comfortable owning this entire business outright at this price? If the answer is a resounding yes, then it's likely a good investment. If you're only buying it because you hope the price goes up next week, that's speculation, not investing. Let's try a mental exercise. Think about the spring of 2020. The world was shutting down. Airlines, cruise lines, restaurants, and hotels saw their businesses evaporate overnight. The uncertainty was off the charts. Nobody knew how long it would last or which companies would survive. Stock prices across these sectors fell by 50, 60, even 80%. That was a moment of extreme distress and extreme uncertainty. A Dhandho investor would not have run for the hills. They would have rolled up their sleeves and started digging. They would ask questions like, which of these airlines has the strongest balance sheet and can survive the longest with no revenue? Which hotel chain owns valuable real estate that provides a hard asset floor to its value? Which restaurant company has a strong brand and a loyal following that will return once things reopen? They would be looking for the low-risk, high-uncertainty plays. The company that was priced for bankruptcy but had a very real chance of survival and eventual recovery. The potential upside, buying at those deeply depressed prices, was enormous. The risk, if you chose a company with a strong balance sheet and a durable moat, was far lower than the market's panic suggested. The Dhandho framework isn't just a stock-picking strategy. It's a way of looking at the world. It's a business philosophy focused on survival and opportunism. It teaches you to separate fear from fact and price from value. It's about understanding that the biggest rewards often come not from taking the biggest risks, but from finding situations where the risk has been systematically wrung out of the equation before you even make your move. It's about playing a game where the odds are stacked in your favor. The Patels did it with motels. Mohnish Pabrai does it with stocks. The principles remain the same. Look for simple, understandable ventures. Wait for them to become available at a price that offers you a massive margin of safety, often because of temporary problems and widespread fear. Ensure there's a protective moat. And then, when you find that rare combination, act with conviction. It's a patient, disciplined, and profoundly logical approach to building wealth. The core lesson is that you don't have to be a genius innovator to get rich. You just have to be a rational, patient cloner who knows a good deal when they see one and understands that the most important rule is to not lose money. That is the art of Dhandho.